Now, what impacts the price of options or the options premium? Recall that this is the price of the options contract and it is different from the price of the stock and strike price. These are the common factors that impact the options premium. The current stock price of the underlying stock, the expiration date of the option, the implied volatility of the stock or option, and lastly, liquidity. When a stock goes up, it will increase the value of the call but lowers the value of the put. And the opposite happens when the stock goes down. The call loses value while the put goes up in value. Quick recall, holders of call options want the stock to go up, so the value of the call will go up with the stock price. And the holders of put options want the stock to go down, so the value of the put will go up when the stock price goes down. This is options fundamental, so if you understand that, you will understand this logic. Longer dated options with expiration dates that are far out will have a higher value for both calls and puts. And for shorter dated options with nearer expiration dates, they will have lower value. So it doesn't matter if you're bullish or bearish, the more time you have, the more expensive the option is. And the less time you have, the less expensive the option is. And the reason behind this is that the more time you have, the higher chance that things will end in your favor. In a longer time period, anything can happen, right? It can go up a lot more or down a lot more. But in a shorter time frame, there's a lower chance due to the narrow window of things ending at the price target that you want. So that's why more time is valued. The stock's implied volatility is a measure of uncertainty. The higher the implied volatility, the higher the uncertainty. So we'll have more value. This logic is that if there's more uncertainty, then anything can happen. So even your target prices, even though it's far away, can be achieved when there is high uncertainty. But uncertainty does not mean direction, meaning that the higher uncertainty can be highly bullish or bearish. It can go up a lot or it can go down a lot, right? It's very uncertain in terms of the direction. So that's why when there is higher implied volatility, then both the values of the calls and the puts will go up. And when there is lower implied volatility, then the price of the option premiums for both calls and puts will go down. So two things the market values more: a far or longer expiration date and higher implied volatility. And lastly, we have liquidity, which is a term us traders use to talk about how much trading action is taking place for a stock or option. If a stock or option is highly traded, then it is highly liquid because you can easily buy and sell it because there are a lot of market participants. So it's very liquid, making it easier to trade. But if something is illiquid or low liquidity, then that means there are not much trading going on and you will run into problems with your orders getting filled because there are not a lot of other market participants that will take the trade with you. Stop and think about a market for a second. A market is where you go to buy and sell, right? So similar to here, we're buying and selling stocks. Now, if this market has a lot of market participants, lots of buyers and sellers, then it would be easy for you to place a trade, right? If you want to buy, there's going to be a bunch of people ready to sell to you. If you want to sell, there's a bunch of people waiting to buy from you. Whereas if you're in a market with very few participants, then it will be harder for you to find someone to trade with. So how liquidity will affect your options price is when there's high liquidity, it will make it easier for you to fill your order. And it would also make the bid-ask spread narrower. You can think of this as more precise prices The spread between them might be in pennies, so you will get what you bid or ask for. Whereas when there is low liquidity, the spread will widen. So the prices you're getting quoted for an option will be very wide. It can be like for $5 to $10. That's a wide range, right? You're trying to buy or sell this, but you don't know where in that $5 to $10 where this trade will trigger. So low liquidity will also have a harder time to fill. And again, that's because there are few participants. So keep these factors in mind when it comes to option prices. It's important for us as option sellers to know when options go up in value so that we can take advantage of it to sell at higher prices.